Hi guys, this is Marcel Pechman and welcome to Macro Markets. I'm an analyst and writer at Cointelegraph. Today is Friday, March 3rd, and we discuss the impact of the macroeconomic news and events on the crypto space. The best thing is, I'll explain everything in layman terms and focus on the cause and effect of the traditional finance impact on the day-to-day crypto trading activity. For today's show, I would like to start by analyzing the US Federal Reserve interest rate and its relationship with the cryptocurrency markets. So, what's the angle here? We all know interest rates are a detrimental risk for assets. So the higher the interest rates, the worse it is for stock markets, real estate, for housing, for cryptocurrencies. Well, if you want a very simple model, yes, that is correct. However, the stock market and commodity traders are not trading exactly what we're seeing right now. Investors make predictions for the future based on the interest rates, based on the relative strength of the US dollar currency, as we discussed on the previous week's show, the DXY index. Well, if you don't believe me, I have a chart to show you. So the Fed funds, it's the orange line on the left scale, starting from 0.15% all the way to 2.5% in 2019. So the blue line is the S&P, the stock market index, measured on the right scale. So notice that when the Fed funds rallied from 0.5% in 2016 to 2.5% in 2019, here 0.15 to 2.5% in 2019. The stock market eventually corrected, the blue line, saw a 16% correction. But it took less than 4 months to recover the level, the same peak, prior to the interest rate increase. And the market continued to rally. So what I'm saying basically is that it doesn't matter if the next meeting, for example, on March 22nd, or the latest meeting was supposed to be 0.25 basis points, so 0.25% increase, and it was 0.50%. The market participants, the investors of risk assets, are always focusing on 6 months, 1 year ahead, so they are already trying to predict when the Federal Reserve will further increase or revert the trend from the interest rate movement. Let's understand the relationship between the stock market, so the S&P 500 index, and Bitcoin. The first thing I want you to learn is never trust charts. Yes, you heard me right. Anyone can pick a time frame, scales that will favor or not the relationship between two assets. For instance, on this chart, notice how Bitcoin, the orange line on the left scale, closely tracks the S&P 500 index futures, the blue line on the right scale. So the ups and downs perfectly mimic each other. The trick? I've used logarithmic scale for Bitcoin and cherry-picked a period of extreme movements for both assets, namely the bull run after the March 2020 crash. So the high amplitude, the high volatility, the big oscillation in the period makes the remaining difference seem like a rounding error to our visuals. Do you want to see the trick in real time? So I'm going to show you another chart. It is basically the same chart. So Bitcoin is the orange, left scale, S&P futures blue on the right scale. The trick is I removed the logarithmic scale on Bitcoin and I zoomed in a period in 2021. So from April and May 21 up to December 21. So a shorter time period instead of 3 or 4 years. And you notice what happened to the correlation between the two assets? They're not any longer moving in sync. It's gone. So the trick was All I did was zoom in to a shorter period, proving that our eyes can easily fool us. So there was no correlation for over 6 months in 2001, 2021. Yet, when you analyze a larger time frame with huge oscillations, this seems like a rounding error. So that's the trick that chartists and analysts tend to do. So don't trust your eyes when doing analysis. Always select different time frames. Avoid using logarithmic charts for comparison on long terms, because it tends to make them look much more similar than what they actually are. So I'm not saying that the correlation between Bitcoin and the stock market is non-existent, but it tends to increase when there's either excess capital, meaning artificially low interest rates, like we've seen over the past 2 years. On the other hand, when investors fear a recession or the cost of capital is extremely high, that's when the fixed income investment becomes more profitable than risk markets. So it's bad for everyone, from commodities, stock markets, housing, cryptocurrencies. So artificially high interest rates cause risk market depressions, hence higher correlation between the S&P and Bitcoin. On the other way, artificially low interest rates, meaning free money, a lot of liquidity on the market, means there's a bull run for everything. So stocks, housing, commodities, cryptocurrencies, Asian markets, everything is going up, and the correlation between the S&P 500 and Bitcoin is too high. It is usually driven by artificially low interest rates. So wait, let's do a quick recap of what we learned so far. Number 1, analysts and news and the intraday traders put great importance on the Fed decision, the interest rate decision that happens every 2 or 3 months. But investors and long-term price of the assets don't really care if the interest rate increase or decrease over 0.25 or 0.50. They are pricing today's market based on how the economy will be looking 6 to 12 months ahead. Number 2, charts and indicators can be deceitful. There's always room to wiggle on the settings, time frame, scales, etc. So don't blindly trust your eyes. Now, on to the next topic for today's show. We'll be discussing volatility indicators, including the stock market VIX index. Volatility is a measure of how extreme daily price changes are. It is usually measured in annualized terms. For instance, gold, the precious metal, has a 16% volatility, 60-day measure. On the other hand, Tesla, the auto builder, electrical companies and batteries, etc., from Elon Musk, has a 94% annualized volatility. So gold 16%, Tesla 94%. There's nothing wrong with those metrics, except the reading that some analysts have. Typically, we'll hear that an increased volatility means a big move is expected. Well, it turns out it is exactly the opposite. The standard measure for volatility is historical price oscillation, either 30 days, 60 days, or 100 days. Having said that, if the volatility is sensibly increasing, it means that a big move already happened in the past. It's not predicting the future. Let's have a look at Tesla's chart from October 2021 and its amazing 55% rally. So the blue line is the price of the Tesla shares on the stock market, and the orange area is the historical 60-day volatility indicator. So the rally happened here in October 2021. And where was the volatility indicator before the pump? Well, you guess it. At the lowest level in more than 2 years, at 34%. And after the volatility went down, we had the huge pump. And you're gonna question, on the other hand, when was Tesla's peak volatility? Well, I'll show you another chart from 2020. So the peak volatility, so it's the orange area on the indicator, neared 153% in April 2020. So what happened as the volatility peaked to 153%? Well, over the following 50 days, there was a small incremental 16% on price. So the next 50 days were relatively calm. Nice, steady, little gains day by day, so nothing unusual. After the volatility had peaked to 153%. So what I'm saying is there's nothing wrong with the volatility metrics. It's just that analysts and news writers tend to forget it is a historical indicator. So it's not trying to predict the future, it is reading exactly what happened over the past 30, 60, or 100 days. And remember about the VIX index that we mentioned earlier? So the VIX index, VYX, is nothing more than the S&P 500 volatility. Except it had some trackers, such as the ETF and derivatives instruments, so that one can easily bet on the indicator going up or down. Overall, readings for the VIX index above 30 are extremely high, and a VIX index below 15%, is unusually low. Currently, March 3rd, it is sitting next to 22%, so relatively low, but nothing extreme. So let's go for a final recap for volatility. The most common volatility indicator is backward looking, causing some analysts and pundits to call wrong shots. A low volatility usually precedes a large move, although it doesn't say which direction. So whenever hearing volatility, forget trying to predict if the market is going up or down. Volatility doesn't care if the stock price went up or down, it's a matter of price oscillation, so absolute movements. Well, that's it for today. Remember to like and subscribe the new Cointelegraph Markets YouTube channel. Will be airing every Friday at 12 p.m. Eastern Time. So make sure to like and subscribe. Hope you guys enjoyed. See you next Friday on Macro Markets.